Testing, testing, testing. Let's see. JB here. Hope you're doing outstanding. October 23rd, 2023. Let me just put this thing out. Just gonna get on audio. I haven't talked for about a week and a half. Talk about O'Reilly or AutoZone, that do-it-yourself auto sector. Sherwin-Williams reports earnings tomorrow before the open. The chip sector, right? So Lam Research, some puts last week. NVDA, which was hitting lows in the pre-market, reverse course, almost at highs right here, up nearly 4%. Talk a little bit about that. MDB, the S&P. We have the PCE data that comes out, I think it's on Friday. Let's see. GDP comes out Thursday, the first read on third quarter GDP, and then PCE data on Friday. So certainly interesting. This will be recorded. But first I'll talk about O'Reilly. And I added AutoZone puts 2 weeks ago on the premise about this situation with rising rates eventually forcing these high leverage companies to curtail some of their spending in regards to their return to shareholder programs, dividends, stock buybacks. When you have leveraged when you have financed a lot of those shareholder programs with debt at a very low rate, and now that rates have risen and the debt is coming due, the principal is coming due, what's the outcome? The outcome is they have to kick the can further down the road at higher rates, probably not going to do as big a dividend, not do as large a stock buyback. Not only that, to finance that debt, it's going to be more expensive. I have to get the exact numbers on AutoZone, which I don't have at the moment, but to know, I think it was $50 million a quarter for Domino's Pizza. So Domino's Pizza, just because of their debt and servicing their debt, it costs them $50 million in profits every quarter just to finance that debt, and that's at low rates. Now as some of that principal starts coming due, and I talked about Domino's Pizza, over nearly $2 billion in principals due by 2025, if they have to start looking to kick the can down the road on that, it's obviously going to cost more to finance that. It's going to weigh on earnings, going to weigh on their ability to return shareholder equity, so or at least have their programs that they have in place with stock buybacks and dividends, which makes the companies more attractive. So I'm not going to sit here and talk about O'Reilly and AutoZone, which have done the similar. They've had the similar setups where they have a tremendous amount of debt, and I don't know if it's $7 billion for O'Reilly and $12 billion for AutoZone. Have to look at the numbers, but they have a lot of debt. And the thing is, what's good for them is they've been profitable, so they can look out to the future and say, okay, I think we're going to be able to pay off this debt. We can use our equity or our market capitalization to get these huge debt deals, and then return those to shareholders via the buybacks and dividends. And at some point, that's probably not the case. And who knows, maybe rates tumble a year from now, 2 years from now, and they look pretty smart. I don't think that's the case. And I think, if you asked AutoZone or O'Reilly 2 years ago, or even Sherwin-Williams, if they thought that they would have to be paying 5, 6, 7% on their debt, they would probably laugh at you. But needless to say, O'Reilly reports earnings tomorrow before the open. I was looking at I had AutoZone puts for the 2400 move, which did not happen. Sure enough, what happens today? It's down to, was it 2457? The difficult part is those puts are very expensive. So to trade on a risk-reward basis with earnings, it's tough. I guess the good thing is, take it with a grain of salt, they have monthly strikes. So I looked at O'Reilly, was able to get a fill on a couple inexpensive out-of-the-money puts. I've talked about some of these auto parts sectors for quite some time. Nobody talks about the looming EV vehicle boom, right? So back in the day, they would talk about, if you were long AutoZone or O'Reilly, they would say, oh, used car sales, they're up. That means that people are going to be looking to maintain the vehicles, going to AutoZone or O'Reilly, buying batteries, windshield wipers, whatever it is. And I think the biggest searched item for a auto parts or do-it-yourself auto parts store is tires and windshield wipers. But what happens with these EV companies, right? So in batteries, right? Do you need a battery anymore with the advent of EVs? And self-driving, all these technology advances that have happened that probably are not baked into the stock, but people still look at it because they're very profitable. But I look at O'Reilly and I'm like, why do you need them? You go to Amazon, you can order parts, go to YouTube to find out. Even if you need a part for your car and you want to fix it, go to YouTube, find the part you need, order on Amazon. It takes out these brick and mortar names. But anyway, needless to say, these stocks have been on a tear. I've been wrong on that for quite some time. I think at some point it'll come to fruition. Got some of those O'Reilly puts, so we'll see how those play out. So hopefully you understand my thought process on adding those puts today. Sherwin-Williams, yeah, again, also reports. Actually, O'Reilly, I think, reports Wednesday after the close. Why am I saying Tuesday? Did I say Tuesday? Wednesday after the close, October 25th. So have a day and a half. So would love to see a nice downward move today, tomorrow, and a little bit on Wednesday, and then be able to lock some in, cover costs. Sherwin-Williams reports tomorrow. So unfortunately, I don't have an opportunity to have some time to lock the rest of my puts in. Ended November strikes. October's were paid out pretty nice. Of course, I wish I had held when it broke into the low 240s. I would have got 10 bags instead of I think I got 2 or 3 bags. Similar story, right? High debt, home sales are down, right? So when people are buying homes, what do? They go and they paint their houses. They go to the Sherwin-Williams outlet store. They want to get 10 rooms done. They buy 10 cans of paint, whatever. But when people aren't buying homes, what happens? That demand kind of wanes a little bit. And I'm not saying Sherwin-Williams is going to zero or the business model is done. I just think there's an opportunity play for downside. So I wish I was looking this morning at the open, went down to 236. Would have loved to close some of my puts into cover cost. Probably just going to hold the rest into close here. Because I think, even if it's an inline number, I think it might sell off. And PPG, which is the biggest coatings company in the world, reported earnings on Wednesday last week. Nice report. They actually raised guidance and the stock still sold off. So I think we're kind of in this environment where companies are going to report great earnings and the market's just going to sell it off because of the macro environment as opposed to the micro environment. So that's kind of a little bit of Sherwin-Williams, so I'll probably hold those. Excuse me, Domino's Pizza, Lulu, I'm not going to talk too much about those because they paid out pretty well, but then they've been somewhat stubborn, so I'm not going to try and chase those on the downside. What do we have here? 428.60s. Okay, sorry. Weight Watchers, I know I keep trying to, some people, I get emails or messages when I don't put Weight Watchers on the watch list because people are saying, oh, what are you not bullish Weight Watchers anymore? The Weight Watchers story has not changed, right? So if you take a look what they're doing, and even this weekend, local newspapers, everywhere I read, there's a new article about Ozempic or Wegovy or Mounjaro or weight loss drugs in general. So that backdrop's not going away. It's just who's going to be able to take a piece of that pie as it grows. It's going to grow. It's going to continue to grow exponentially, especially as the supply of these drugs come online, more companies get approvals. The FDA approves more drugs, and not only approves the drugs that are just specifically for diabetes, they'll start to say, no, you can use a weight loss now. And then as some of these symptoms or events that weren't covered or weren't part of the drugs in the past, now FDA might say, hey, you can take these GLP-1 drugs to reduce cardiovascular events. You can take these GLP-1 drugs to reduce your fatty liver and NASH symptoms, which is an epidemic. Well, I wouldn't call it an epidemic, but it's an unmet need for that whole sector. I think it's like a $2 billion opportunity at least on a year-over-year basis. So when you take a look at what these insurance covers are doing, since there's such a high demand for it, you need to have some kind of I wouldn't call it therapy, but counseling. You need to be on some kind of program for 6 months, then you can get approved. Weight Watchers fits right into that. I think it's just a matter of time before most of these insurers take that as pretty much just the opening stages of being able to get approved for these drugs, and it's just going to push members to Weight Watchers, especially with their iconic name brand and the fact that they can finally get the clinical side for these patients. They can get coverage. They have the back end where they can look to get coverage, look to get the prescriptions, look to get you reimbursed, things like that, where they didn't have that in the past. So the story hasn't changed. They report earnings November 2nd. My thoughts on Weight Watchers. I think it's, if it continues to drop, it's down here at 960. Maybe I'll look to get some more later dated strikes, but right now I'll just hold what I have. That's Weight Watchers. What else did I have on here? Yeah, I keep talking about this 415, 416 on the SPY. So if you traded options or the markets on a pretty active basis over the last 10, 15 years, I mean, there's been moments over those 10, 15 years where there's been opportunities for downside. And when I say downside, 2, 3, 4 days where the market drops 10, 12%. I don't know if we're in that stage yet. I mean, I'm a glass half full kind of person. I look at the market and I say, well, I don't like to have my bear suit on, but I think I'd rather play bounce opportunities than to play for downside. Right now, I think I'm on flip side. Not that I don't have I have a bear suit on, but I think there's more opportunity for downside. It just, we have right now the geopolitical situation with the Middle East, the rising rate environment. A lot of people, and I went on rants over the last couple of years around the U.S. debt. The fact that the U.S. debt costs more to service the U.S. debt than to pay for the U.S. military is just crazy. And as the rates continue to rise, it's just going to get more expensive for the U.S. to finance their debt or service their debt. So that's one issue. And then now we have the potential of this government shutdown, November 17th. They kicked the can down the road in October. Now we have this whole fiasco where it's not only do we not have a system to get an approval or kick the can down the road again, it almost seems like that's what's going to happen. We're going to get to that point, and we're going to have these credit rating agencies downgrade the U.S. credit rating. It's kind of scary. So I'm not here. I don't fearmonger. That's not my thing. But I think there's just more opportunity for downside. At least 415, 416 on the SPY. And I think the telling point this week will be the earnings. So we have Microsoft, Google Tuesday, then Meta Wednesday, then we have Amazon on Thursday. And there's a lot of other big cap names, the credit card processing companies, things like that. A lot of multi-billion-dollar valuation companies reporting this week. If we have some of these names, and I put on a watch list this morning, I think Google and Microsoft are going to report great earnings tomorrow. And it's the reaction that's going to probably be something more to pay attention to than the actual numbers, because if they beat and raise and the stocks sell off, I think there's going to be more, you peel back the onion, right? They peel back the onion and say there's probably more to the sell-off than just what's going on with earnings or what's going on with the Fed or whatever. It's probably a longer-term situation. So those are things I'm looking at. At the same token, I talk about passive money. So you take a look at the bounces. We had the bounce 2 weeks ago after we hit 420 on the SPY all the way up to 438. Again, this morning down to, I think we had 417.98, 417.80. And then within a matter of an hour, we're up over 420 with no catalyst. There's no news. There's no, no rhyme or reason why some of these stocks, take a look at the video. When the video reverses 5%, it's a $50 billion move in valuation just because. There's no reason, no rhyme or reason. So we'll have to see how this all plays out. But to me, I think it's passive money. At some point, there's not as many sellers as there are as buyers, and a lot more buyers because passive investments, pension funds, 401ks, brokerages, all those things go into buying, and there's not as many. There's no 401k that says, oh, I'm going to, 90% of the 401ks don't short the market, they buy the market. So it's just how it is. And at some point, I think that we'll find some more pressure. I don't know if it's going to be today or tomorrow, but earnings tomorrow after the close with Google and Microsoft are certainly going to kind of set the stage for what goes on for the rest of the week. So I think that's it, folks. That's my little rant. I'm not out of breath today, so that's a good thing. So Weight Watchers. Oh, AVAV. So, if you don't know the story in AVAV, I think it was one of my top 5 stocks a couple of years ago. But, I mean, drones is the future. Drones is the future of warfare, of intelligence, being able to fly above your enemy, be able to take a look at their deployments, things like that. And here's AVAV, one of the most, when I don't even know how it compares with peers, but they have a lot of military contracts, have over $500 million in back orders. The company's only valued at $3 billion. Back with when Ukraine and Russia were just kind of starting to heat up, the U.S. military placed a huge order with AVAV. But then on the flip side, there's people who've been short the stock from way lower than where it is now. And they talk about an inferior product. They post these pictures of how it looks like they just duct taped rotors together. I don't even know. I would have to go back and look at the pictures. But, you know, if you had your first encounter with this company was that short piece and you looked at the pictures and say, wow, this company is a zero. And meanwhile, here it is at, 118, 119. But it's kind of like an under the radar defense play where I think the company has 130 million in debt, 130 million in cash. So it's pretty a net zero in terms of liability. So that's a good thing. Over $500 million in back orders that they're setting up. And I think their normal revenue is 600 million a year, and it's going to scale up to over 700 or so in 2024. So it's just, I think it's just a great story. And one of the analysts came out, and I guess they had they had a conference they were at, and it just they kind of hinted at some contracts coming. So I just think it's a good story. Got those Octobers, locks them in for some nice profits, and of course it sold off from 120. I think it heads into the mid to high 120s in the coming week or two, and then over 130. MMM's not my type, or at least recently. MMM, who's the other one? J&J. Some of these names that just have been, IBM reports earnings this week, which is ironic. So IBM, I had calls. I think I had the 150 calls. Let's see if I can pull it up. I had the 150 calls in August, and I think the stock was trading at 140 or 138. Sure enough, goes all the way up to 152. Actually, maybe I had 140s. I have to go back and look. But I sold them way too early. But here it is. IBM's down to 136, right near, it's nearing its 200-day moving average. That could be one. IBM, I talk about companies that have leveraged, taken debt, and use that to finance, shareholder programs via dividends and stock buybacks. IBM's the poster child for that kind of transaction where they take their equity or they raise debt or whatever, and then they just use it to buy back stock and issue dividends. And I think IBM has reduced their outstanding share count by like 80% over the last 10 years, and the stock is still kind of just muddling around, but that doesn't include dividends. So, if you're an IBM shareholder, you're probably still doing pretty good, but not going to trade it this go around just because I don't know. I'd rather trade some of these more volatile names right now into earnings. I think that's it, folks. I'm trying to look at some of these other names I was looking at. AutoZone, Sherwin-Williams, AVAV. Oh, yeah. Gosh, Unity. So, back, I think it was the Apple, which day was it? Well, needless to say, when Apple said when they announced their goggles, I'll just call them the goggles, they, Unity came up, right? And then Unity was going to be a part of the software. It's going to be, of course, when you come out with a new product that requires apps and software to go with it, and you partner with a company to help build that, you would think the stock would be up crazy. And I think it went up to $50, and now it's pretty much cut in half. So I'll probably stay away from that one right now. Yeah, I think $50 back in July, right? So I'll probably stay away at some point. And let's see, is it Pynchon? I think, did you get upgraded or downgraded this morning? There was an analyst out this morning. Yeah. But anyway, that's it. That's all my rant. For now, I'll try and get back on audio later or tomorrow. Let's have a great day. Rock and roll.